So Seneca is a multi-asset specialist, and that means that we invest in a very wide range of asset classes, and it also means that we cover the globe. So we have to be extremely well organised. We have to have a very well organised team. We've got 5 investment professionals, 5 fund managers, and each of us has 2 responsibilities, a research responsibility and a fund management responsibility. Now, all of our funds, including the trust, is divided into 5 segments. There are 5 areas where we're trying to add value. We've got UK equities, where we invest directly and have a focus on mid-caps. Then we have overseas equities, fixed income, and specialist assets. And on top of all that, we're also trying to add value from tactical asset allocation, which actually is my research responsibility. So all of the fund managers are allocated one of these areas, and it's their job to make recommendations for all of our funds for investments in their area. So we're very well organised. Now, the next question, of course, is, well, how do we make investment decisions? What is our investment style? And there we have a very clear focus on value-oriented investment style. All of our investment decisions are made on the basis of something being cheap, a market being cheap, a UK equity being cheap, picking third-party managers who themselves have a value-oriented approach. So we're very clearly focused on value. And there's also one other thing I'd like to say, which is that actually the structure of all of our funds is quite simple. You lift up the bonnet, and you can actually see very clearly what's going on. We're not investing in complicated structures, whether that's derivative strategies or hedge funds or structured products or whatever it might be. We're trying to invest in very simple investments, and actually we tend to find that helps on the performance side, but also for investors. It's important for them to understand what we're doing, and that gives them a greater degree of comfort as well. But ultimately, it's all about having a team approach, and we think that's exactly what we have.
Yes, I think perhaps the first thing to say is that we are fairly unusual in that there aren't many other multi-asset managers operating in the investment trust area. But in terms of how we operate our multi-asset approach for the investment trust, we had agreement from shareholders back in 2012 to our long-term strategic asset allocation of 60% in equities, 15% in fixed income, and 25% in specialist assets. And within that, we have also agreement from shareholders to operate within a range for tactical asset allocation purposes. I think one of the benefits of multi-asset is that you do lower volatility, and certainly we would expect to have much lower volatility than pure equity funds. But I think the value approach that we take as well is also helpful, I think, in dampening volatility to a certain degree. But also, I think when we're fundamentally looking for cheap stocks, good managers who sort of operate in the same way that we do in terms of trying to identify good quality companies, but at decent low valuations. It does tend to lend itself also to protecting capital, and we passionately believe that we should be trying to protect investors from permanent loss of capital. So great that we can offer low volatility, but much more important, I think, that we can ultimately, by identifying cheap situations across the range of assets that we're investing in, offer that protection to, without guarantee, but clearly some sort of cushion against loss of capital. I think the other differentiating factor perhaps to other multi-asset managers is that 25% allocation that we have to specialist assets, which these could encompass renewable energy, they could encompass and do encompass areas such as leasing, property, and those are assets which we've introduced to the portfolio both to dampen volatility but also to give further diversification to the portfolio, but also I think to offer something which is uncorrelated to some degree to other assets that we're investing in, therefore acting as very good diversifiers to the portfolio. Yes, so, the multi-asset approach that we have very much lends itself to lowering volatility when you think that we're investing across a very wide range of assets, all of which may be performing in different ways and in different phases there at different times. But we also believe that the basis on which we're investing is very much centred on the income and the yield that can be achieved from the various asset classes. And I think there's a fundamental belief that will, over time, produce returns, not only in terms of long-term returns, but should also be fairly protective in terms of any short-term market movements. The ultimate objective is clearly to provide not only a good level of income, but also some capital growth. And whilst that's going to be difficult to achieve in some difficult market environments which may lay ahead, we do believe that the process is very robust, that the income is derived from a very wide range of assets, and therefore there's a resilience to what we do, which I think should, over time, produce good risk-adjusted returns for investors.
So the ultimate question for us, for any investor really, is about what's going on with the economy, what's going on with the global economy. And really, the global economy at the moment isn't performing particularly well. It hasn't really been performing that well for the last 5 or 6 years, since the crisis, in fact. And there's all sorts of reasons why that's the case. But our view is that we're probably going to continue in the same manner for a little while longer, which should be okay for equities in that economies aren't going to be overheating in the near term, which would be bad for equities, nor are economies going to be tipping into recession anytime soon, which is also good for equities. If you look at valuations, they're not fantastic, but they're okay. Dividend yields generally are above historic averages, and in the context of very low interest rates, that also provides some sort of valuation support. So I'm certainly not maximum bullish on equities, but we're reasonably confident that they can continue to advance. Now, I mentioned interest rates. Bonds are very expensive at the moment. Developed market government bonds, which you can think of as being safe haven bonds, are extremely expensive. Nominal rates are very low, and that means that given inflation where it is, real interest rates are very low as well. And that means for us that they're not great long-term investments. The third area that we look at is specialist assets. Now, these can be thought of as vehicles such as real estate investment trusts or private equity or infrastructure vehicles, asset leasing vehicles. They're generally listed on the London Stock Exchange, and a lot of these things offer extremely good value. They offer yields in the order of 5, 6, 7, 8%. And that means that we are finding an awful lot of value there as well. So that I hope summarizes what we think about the world.